recording now?
I believe, yes.
Okay.
Morning.
So we will open the Retirement Plan Advisory Committee meeting on February 25th at 6:05.
As first order of business, we need to appoint a chair and a secretary, but since we don't have a quorum, we will appoint a temporary secretary, which role I'm willing to fill. Bobby, okay with that?
Absolutely. Thank you very much.
All right, we'll call a roll. Chris LaBrace is here. Bob Hamill,
Here.
Steve Doka, absent. Jane Yao, absent. Okay, we do not have a quorum.
Right.
Therefore, we cannot transact any business, but we can proceed with the meeting. So,
Great.
floor is yours.
And may I ask who's in the room, just because I'm
Yes.
trying to.
I'll start. I'm Diane Wilson.
Oh, hi, Diane. The screen is very small.
Yes.
I'm working on an iPad, and the investment review is taking up 3/4, so I can't see who's there.
Hi, Bob. It's Anne Philip, I'm the CFO.
Yep.
And this is Rich Nolan with Russell Investments.
Okay, great. Thank you. I'm sorry to ask. I literally can't make out, and I'm curious. Thank you.
Can't see who's here on the Zoom. Okay.
Okay, take it away.
Okay, perfect. Thanks very much. So again, Rich Nolan with Russell Investments. I oversee the strategy and the relationship across each of the 3 portfolios that we're managing on your behalf. The team that we have, and I'm based out of Fairfield, so this is a nice one for me to come right down the road here. And then my 2 colleagues who also serve alongside me on your account, Justin Owens and Jackie Pedraza, who we've both met in person, or you've each met in person. Justin Owens leads up our asset allocation strategy team. I call him the architect on the asset allocation that we develop. He's an actuary by trade, so he utilizes the actuarial inputs for each of the plans that you have to come up with an asset allocation framework that supports your plan's goals. That'll be a primary discussion that we have today. And then Jackie Pedraza, who also leads up the account executive team, who serves overseeing the operational and the administrative side of the plans and portfolios as well. Both based out of our Seattle headquarters, and among the 3 of us, hopefully we have at least some form of an answer for any questions you may have here.
So Jackie and Justin are in Seattle?
That's right, yes. Yep. So I'll flip through here. This is a number of the pages that you're going to see that we'll cover are going to become more populated, of course, as time goes on. Some of these are still in their infancy, if you will. We like to keep a running log of all of the key action items that we've completed here on slide 4. And so the primary motivation today will be the asset allocation analysis. You can see that under the bottom left, which is the action item, also known as the strategic review. The exercise that we're completing here is undertaking an analysis to determine if we have the right asset allocation for each of the 3 plans, and if we have any primary recommendation for the 4th, which we do have, which will mirror what was, and Bob might recall, which was put forth to the board at our last meeting in October.
Okay.
I'll keep flipping through here on slide 5. This is our executive summary, key inputs and takeaways from an asset allocation performance and market value reconciliation standard. I'll touch on each of these in a bit more detail here. This simply represents the funded retirement plan. So you can see the asset allocation breakdown on the top left, which we will be reviewing in a bit more detail. The performance that you can see over the shorter term time period, the 3-month period, the portfolio down about 1.9%, call it right in line with benchmark. Since inception of our management of the plan going back to early October, the portfolio is up about 3.7%. And then on the bottom left of slide 5 here, you can see outflows throughout the period, largely being benefit payments of about $2 million, exacerbated by about $3.25 million in market losses throughout what was simply a difficult environment throughout the 4th quarter. To spare you the suspense, a lot of that market comeback has returned in the first, call it 7-8 weeks here in 2025. To give the highlight on the executive summary on slide 6, from a markets perspective, you can see that the box with the major asset class returns, that's a theme that we're going to come back to in just a moment here, which is US equities dramatically outperforming every other asset class. The key watch points and market risks on the top right, what keeps us up at night when we think about asset allocation and building portfolios, market concentration that refers to the Apples and the Googles and the Metas and the Nvidias leading the entire charge and a number of other stocks being left behind, if you will. Federal Reserve action refers to the fact that we've just come out of a historic rate hiking cycle and now we're on potentially better end of that with rates coming down. Rates are down about 50 basis points in the past, call it 6 weeks or so, so potentially in the easing phase. But then the other concern is markets priced to perfection. So valuations are high, markets are priced as if everything's going to keep chugging along in the way that we want it to. And there's usually some bumps in the road, so preparing for that accordingly. The bottom portion that you see here, the economic probabilities, I would summarize it as the bull and the neutral case. That's the combined probability that the economy continues to truck along in a positive manner. The bear case scenario, I'll use the R word, the recessionary scenario, potential contraction in the economy going forward at about a 30% probability over the next 12 to 18 months. The good news is that's getting better. The last time we met just back in October, we had that at about 35-40% probability. Conditions have continued to improve. Two more slides very quickly here on the economic and market side. A lot going on, but just to orient you, each of the different colors here on slide 8 represents a different asset class. There's two key themes and takeaways I would draw your attention to. On the left side of the page, the fourth quarter, as noted earlier, very difficult and painful period for almost every major asset class. You can see -8s, -9s, a difficult period with one major exception, which is that blue bar. That's the US equity market up 2.5%. Over the 1 year period, that theme continues with the US equity market dominating all other major asset classes. Keeping in mind that's the second year in a row where the US equity market was up over 20%. That hasn't happened in decades. So again, considering we want to be cognizant of where valuations are and how expensive stocks and equity markets have gotten. And then the other major takeaway just extends off of that, which is the blue bar here. US equities continuing to dominate every other major asset class. All the way on the right hand side of the page, US equities up 12.5% annually over the past decade. The why there is the US tech revolution, AI, and again, all those companies I mentioned before, the Googles, the Microsofts. I'll warn you, you may have heard of the FANG stocks. That was an acronym that in the past, Facebook, Apple, Amazon, Netflix, Google, that transitioned into the Magnificent Seven. I warn you because this one's cheesy, but the media pundits are already using it. There's now the Batman stocks. That's an acronym which BAATMAN. They included Broadcom. So it's Broadcom, Apple, Amazon, Tesla. There's two M's, Microsoft and Meta, Alphabet, which is Google, and then Nvidia. There's your lineup of all the major tech companies now that are driving markets throughout. One quick note here on slide 9. I really like this slide just because it's a reminder of the resilience of the market. This is a 60-40 portfolio, so not the kind of New Canaan portfolio, but just your broad 60-40 portfolio, and how that stacks up over the last 40 or so years, 40 or 50 years. The 2024 squarely on the right-hand side of that page. I like this page because I think it's easy for negative headlines to dominate and for negative emotion to outweigh positive emotion. And when you can see though, when it comes from a balanced portfolio perspective, the vast majority of years squarely fall on the right-hand side of this page. And then interestingly, every year on the left-hand side of the page is so easily identifiable. 2008, the global financial crisis. 2022, I call that the 2-year late COVID fallout where it finally took place. You have the tech bubble. So, you know, stick to the strategy and play for the long term is really the name of the game here. Finally, as we think, moving forward, I'll skip a bunch of slides. This is our global market outlook. Bear with me here. I'll give you some context. I've never heard of this word Mechazilla until our strategist published this out to the market. And so the question there was, okay, what does that mean and why is it the headline of our global outlook? So you may have seen it, I hadn't. Mechazilla is the name of the Elon Musk SpaceX rocket, which was shot up in summer of 2024, came back to Earth and was caught by these huge mechanical arms. That's an AI-generated exaggeration of the actual device. But so the rocket comes back to Earth, it's caught, it can be used again. And so what does that have to do with markets? The improbable is now possible, but expectations are getting way out of line. And so that's the theme for the outlook going forward. The good news is, as mentioned earlier, you can see the first bullet point, US recession risk has been lowered even further. The labor market rebalancing, the second bullet point, I think that's probably the biggest takeaway here. We spoke about this in October, where 2 years ago, when you couldn't walk by a small business without a help wanted sign on the door, the labor market has fully rebalanced in the sense that there was, at the peak of COVID, 2 job openings for every one individual available to work. We have 5 years later finally gotten back to a point where for every job opening, there is one available worker out there. So we have fully rebalanced the economy without a major recession. We view that as a good sign, of course. Inflation has dipped down to 2 to 3%. CEO confidence is relatively high. There's no major layoffs planned. The CapEx spending has been relatively strong. I'm the first one to tell you, though, when someone sits here and tells you how great everything is, that's probably a good time to be really cautious. And so with that said, we are a new White House administration with policy impacts that we're still trying to understand. Very, very high equity market valuations. We're trying to balance a lot in terms of the unknowns. Put that all together, we maintain a relatively defensive posture within your portfolios, recognizing markets have been up 20+% over the past 2 years. We're willing to be a little bit more defensive and conservative as we move forward from here. Hopefully that was a helpful overview. Happy to take any questions, but otherwise we can flip over into the pension.
Well, why don't we take a pause?
Yeah.
Bob, do you have any questions?
Nope, it's, I, 70-30, it's throwing darts, but if that's the recession thought, can't completely disagree with it.
Well, I just got a question, because I'm sorry, I was a little late, I had another presentation, but the interest rate outlook that you have, it was funny, this morning I was just listening on Bloomberg and they, they're sort of revising their interest rate outlook
Yeah.
to steady and possibly up again.
Yeah, our view is unlikely to see any meaningful cuts throughout the rest of the year,
Okay.
potentially one more cut throughout the rest of the
Okay.
year. At most, and that's likely to be a 25 basis point cut. We think we're done with 50 basis point cuts that we've seen. So also important to note, interest rate cuts or hikes only happen at the short end of the curve for short-term debt. The long end, the 10-year treasuries and what influences us from mortgages, et cetera, that's more a function of supply and demand. The Fed doesn't have control over that. And we've seen those long-term rates oscillating up and down quite a bit based on economic uncertainty. So as inflation is anticipated to potentially go back up, we see eggs at $8-9 a dozen. That has potential impacts of seeing the long end of the curve, which affects us again from the mortgage side of the world more impactfully. The short end, though, as mentioned, we anticipate that that's likely going to be stagnant from here on out. When we listen to Fed Chair Jay Powell talk, it seems like he may be thinking they got a little bit out ahead of themselves with the policy cuts that they put forth already. And so it seems like he wants to take a pause, take a breather on that so far. Great. So what you can see here, this is the funded retirement plan. This is the market value reconciliation. You can see the flows throughout the period. I'll just draw your attention to the 3-month period in the middle. The outflows of about $2.5 million, largely being benefit payments, the market depreciation of about $3.25 million, and you can see the ending market value. This is as of December 31st at about $173 million. The update as of yesterday. So the portfolio in the first, call it 7-8 weeks here in 2025 is up about 3.2%. So the market value as we stand as of the market close yesterday, just shy of $178 million. So about $5.5 million above what you see on this page here. Today's market sell-off notwithstanding. 1.5% here. So
Friday wasn't so good either.
no, it's been four straight losses within NASDAQ. Here on slide 17, so we have our policy holdings. So you can see the underlying asset class breakdown of each of the major asset classes within the plan, and it's broadly a 65-35 allocation. And from a governance perspective, ensuring that each asset class is well aligned with its actual target. And you can see the difference between policy holding and actual holding is very closely aligned. We would rebalance automatically if needed, but sort of check the box again from a governance standpoint, no need to rebalance at this point. And from a return perspective here on slide 18, December was the most difficult period throughout the fourth quarter, but on a 3-month basis, again, towards the middle there, the plan in total down about 1.8% since inception of our management going back to early July, the portfolio up about 3.7%, but then add the other 3.2% throughout 2025 that you don't see on this page. We're up in the past, let's say, 8 to 9 months, about 7-8%. Skip slide 19 and 20. I'll move over to the OPEB plan. One action item that I forgot to mention earlier. I don't believe we have a investment policy statement on file for the OPEB, but I don't know if there is one. And so if there isn't, we're happy to craft one and get that in the reference.
We'll take a look. Yeah, we'll take a look.
Similar exercise here for the OPEB plan. The $22 million balance that you see as of the end of December is up slightly to about just north of 23 million as of today, as of yesterday. Again, from a policy perspective, all of the funds are within their 2% tolerance, no rebalancing needed. And then from a performance perspective, again, a difficult fourth quarter portfolio down about 2.25%, roughly in line with the benchmark relative expectations. This plan also up another 3+% in 2025. I'll draw your attention to this slide on slide 25 here. I know it's busy. Like we call this the look under the hood. Each one of the columns or each color that you see here are the funds that you have exposure to. So for example, you have exposure to, on the left-hand side of the page, a passively managed US large cap index fund. You can see the sub-advisors being utilized. So I like to call it, it's not Russell stock and bond pickers you're getting, it's the stock and bond pickers who we believe to be the best in the world at their individual specialty. Vanguard is as good at anyone at running passive large cap funds. So you can see there the single sub-advisor within that portfolio. The small cap US equity fund in gray, for example, much more elaborate there. That's an actively managed fund. So you can see all of the underlying sub-advisors or sub-managers who are running strategies on your behalf within that portfolio. We research, hire, and fire those managers within the funds on your behalf, so you don't have to do that. And so we're sure to update you when any of those changes take place. We did have one change you can see here outlined on slide 26, as we swapped out one of the managers within your core bond fund. Again, no change in strategy, just ensuring that the fund remains aligned with the positioning that we're looking for.
So just to understand the way your portfolio is constructed, on the US small caps, you have yourself listed as small cap US equity fund. Is that, so that fund is comprised of these 8 sub funds?
That's right. That's correct. So I would call it, just one clarification, sub-managers. These aren't individual funds. These are custom separate accounts that those managers run explicitly for Russell Investments.
Oh, okay.
Yep. So they're not fund to funds. These aren't mutual funds that you could buy off the
So
shelf.
the actual securities are held down here.
That's correct.
In the case of US non-equity and large cap, it's only an index fund, basically?
Both of those are passively managed. That's right.
Okay.
And is that index, is that a total US market? Is it S&P 500? What is the Vanguard passive piece?
I believe it's a Russell 1000. It's not totally.
Okay.
It's large cap only because the small cap active fund is the smaller portion of the market.
And the size of the width of these bars is not indicative of the allocation, right?
That's correct.
You just needed the room because you've got all these sub managers.
That's right. The small cap US equity fund is only, I believe, I'll flip that at a 2% target in your portfolio, as you can see here, whereas the large cap fund is 4%. And so, yes, that's a good point. I'm actually going to.
But so are you saying that 40% of money is managed through this Vanguard fund?
That's correct.
Yeah, it used to be 60%.
Right?
And we have these all as sub-advisors for the
2%.
yeah, for the 2% of assets, because you can't find an index.
No, we have, so just to give a little bit of background, the allocation that you have in place today is mirrored from what you had from your prior advisor during the transition. We took over the assets in the same exact form that it was being managed previously. So now the asset allocation analysis that we're going to put forth in a couple of minutes is intended to explicitly tweak
Okay, so this is as it is and as you inherited,
Correct,
more or less.
as we inherited it within Russell's structure.
Yeah.
Exactly right.
Okay. All right, makes sense. Thank you.
One follow-up question to that. If the previous slide, I thought it said 2% in small cap, yet we have 10 funds, so that's 20 basis points of fund. It just seems kind of like overkill.
So these are commingled strategies that a majority or numerous Russell clients use that small cap fund. So it's not as if we're building a single fund for the town of New Canaan with 10
Okay.
investors. So we're getting the scale across our entire client base.
So we're not losing out on fees because we've got 10 small cap managers for 2%.
It's even the inverse of that. You're getting access to some of these managers who you wouldn't have access to otherwise, and at the scale of Russell's 350 billion in assets.
Okay.
And so if, for example, if we were to run an active large cap strategy, if we were to replace that Vanguard run fund with an active strategy, it would look very similar to what you see on the small cap side. There'd be a number of underlying managers there.
Got it.
Although when you presented initially, like to win the business, I think you said that passive efforts was probably what we recommended.
And we still do recommend.
Yeah, that's why I was like, I did remember that.
And we still do recommend that.
Okay.
Yes. Yep.
And on the bond side, you said Western Asset tossed. I know they've had a couple of bad headlines. Who replaced them in that strategy?
So we reallocated each of the managers that you see here on the right. Those 4 managers were already in the portfolio, and we reallocated Western's portion of the portfolio among those 4 managers. We're likely to add another one to fully replace them. Materially non-public, I don't know the answer.
No, that's fine. I don't need to know. Okay, thanks.
Yep. Any other questions here? Otherwise, we can flip over and continue the review. Skip a number of slides ahead here. And I'll draw your attention just to slide 37. Check your a lot of words here on slide 37, but the strategic review analysis is otherwise known as an asset liability analysis. That's where we collect the actuarial data to ensure that the asset allocation aligns with the goals of the plan, the goals of the board, the goals of this committee, make sure that we have an asset allocation that suits that. The 3 bullet points that you see on the bottom, those are the 3 primary questions that we're trying to address. Do we have the right split between equity and fixed income? Right now you have a 65-35 allocation. Is that the right split? What's the right composition of the equity side? So for example, do we want to gain different exposure outside of just US markets and international markets? Do we want to have exposure to emerging markets or real estate or things of that nature? And then the third point there, what's the right blend of active and passive management? Those are the 3 primary questions we're attempting to address. And now I'll flip over to slide 41. I'll answer that. And so this, by the way, aligns exactly from what we had reviewed in October. No changes made to what was presented to the board in October. And so if you compare the current column towards the left-hand side, that's your current asset allocation today. We model out a spectrum of asset classes that go from what I would consider most similar to what you have today compared to most differentiated all the way on the right. And our primary recommendation, as you can probably tell, is outlined here in orange. And so to answer a couple of the questions, as you can see for the top line, this is a active and passive implementation. So maintaining passive exposure in both the US large cap and international developed markets, primarily to ensure that we're getting access to the most efficient markets into the lowest fee in areas that have the least amount of potential value add, and then maintaining active exposure in the other asset classes that you see here. So for example, US small cap, emerging markets, and the rest of the asset classes you see. Additionally, diversifying into asset classes that you don't have today. So for example, adding emerging markets, which you can see on the 5th line down, adding in public real estate and public infrastructure. These are all daily liquid stocks, but again, just diversifying asset classes that you don't have exposure to today. I think that the key headline takeaway, if you look at the bottom clump of rows there, you'll see the mean cumulative asset return and then the volatility return. So that's your return and your risk expected over the next 10 years. Typically, to get an increased return, you need to take on some form of extra risk. That's not necessarily the case here. Your current portfolio expected to return about 6.7% with a standard deviation of about 10.5%. Moving to the recommended portfolio by diversifying the asset classes into a couple of different areas of the market, anticipated to increase the return potential to about 7.3% and actually lowering the risk profile moving forward. So typically there's no free lunch. In this instance, diversifying into a more diversified asset class exposure allows for that uptick in potential return. I should also note, I failed to mention this earlier, this also moves from a 65-35 allocation to a 60-40 allocation. So it's actually more conservative in its overall breakdown.
But with so like in a rising interest rate environment, this makes me, I mean, I'm just gonna be straight, I used to work in fixed income, so
Yeah.
like, I wouldn't be my time to be jumping into more
Yeah.
fixed income if you think rates might be going up.
Yeah, so I think the primary motivation behind it is it's less tactical, recognizing that we're not trying to time the market in the entry point. If this is going to be a 10 to 15 year allocation, recognize there might be some short-term pain, but willing to take it on from a strategic long-term perspective. Justin, any comments to add?
Well, that makes us, does that make us have to fund, my concern is
The loss of
what we have to do from a budgetary standpoint.
or contribution.
Our contributions, if we have losses, you know, then I feel that pain directly
In the short term.
in the short term.
Yeah, sure.
Yep, no, I'm completely with you. Justin, do you wanna add a couple comments there?
Yeah. As it relates to the contribution piece of it, fortunately, with the way that the actuary calculates that, the assets are smoothed over a 5-year time horizon. So if there's ups and downs in any given year, it's smoothed out, so you don't feel the immediate pain of that. And on top of that, there is about a 10-year smoothing of the underfunded or overfunded amount. So essentially, each year, the contribution requirement is the normal cost, which is just basically the cost of new benefits accruing in any year. And then it's offset by this over or underfunded amount that's spread out over 10 years. So you do have a lot of benefit in that structure with the way contributions. So even if there was a significant loss in assets over the next year, that would be spread out over a long time horizon, in which time there's probably an offsetting year that keeps things from changing dramatically year to year.
You were missing on
Love
that.
having an actuary.
Yeah.
What distinction do you make between non-US and global?
Yes, so it's a good point. Non-US is entirely international and it's developed international. Global is both developed international and US. So the point there is that the underlying money managers there have the latitude to overweight and underweight in and out of the US and non-US markets where they see the most opportunity. So for example, the international managers are only investing outside the US. The managers who are in the global fund, they have a mandate to invest across the entire globe as they see best fit, according to a designated benchmark.
Okay.
And I will note that making sure that we're accommodating for the preference of the board and the town as a whole. This isn't the end of the analysis. We could incorporate the diversifying asset classes that you see here and still maintain a 65-35 allocation if that was a preference as well. So not taking on that additional fixed income exposure.
I mean, I think one of the biggest potential risks is a sovereign debt crisis. Let's face it. I mean, nobody wants to really talk about it. But how that actually would play out in terms of bond prices is a whole new ballgame. The Fed might just step in and buy everything for sale, and rates could actually go down for a while, but ultimately it would lead to a lot of inflation. I don't want to be Mr. Bear on the call, but that's, let's face it, the markets are struggling to issue 10-year bonds, and we're issuing a lot of short-term debt. So I feel Diana's point about putting more equity, or more fixed income in the portfolio. However, in the short run, rates could really go down before they really go up. So I don't know. It's we're in this for the long term. I like the private, the public infrastructure and the real estate, real assets should do well if we do have inflation. So Anyway, just a few observations.
Yeah, it's really good points, and Dustin and I talk about this quite a bit in terms of asset allocation. We're intentionally trying to take interest rate risk off the table as much as possible because we can't time interest rates. And, but we want to be thoughtful about entry points as well. So your points are all certainly well heard, and related to sovereign debt crisis, yeah, that's, we go in a lot of circles about that as well. And whether that unfolds tomorrow or next week is probably unlikely, but maybe it's closer around the corner than it has been in the past. And so there's also the flip side of that, where of course interest rates could skyrocket a sovereign debt crisis as inflation shoots up, but then also a potential flight to safety. People are buying US treasuries because there's nothing else out there that gives them any comfort. So I know there's no answer there.
Nope, there's not.
And this
From the you do that.
Correct.
But I would tend to agree with John on this, Bob, too, that there's no need to add more fixed income, right? Sure. I think fixed income, you don't really get paid to hold it, and when it gets crushed, you get crushed. Yeah. I mean, there's no upside to it. Except you feel, liquidity maybe. Yeah. So I don't know how the others feel, but I would certainly, I like the old allocation, maybe tweak it a tiny bit, but.
I and to build on that, but also to go back to Chris's earlier point, I do struggle a little bit with global equity and then non-US equity. I guess, is it, I mean, you could end up, the global manager could be, very US centric, and you don't really know where you are. I guess if it's active versus passive, maybe that's the distinction that I just have trouble with why those two lines wouldn't be sort of consolidated into one line, in which case we're going up meaningfully in that area. It's off to a good start this year. Maybe it's not a bad idea, but it just, all of a sudden we're at 23% non-US. We're actually larger than we are in US equity. Although we have small cap, we're about equal. Just observations. There's no right answer.
Well, because these global equity investors tend to be, they'll buy US multinationals. So essentially, it's you have your back to US exposure. They're just saying, well, they have a lot of business overseas. I don't think you get the true international component unless you go to the non-US and the emerging markets, because they're excluded from buying US. But I think these global guys, they'll buy multinational companies, but a lot of them are US. So, so if you want to say that maybe we need a managed US large cap portion, that might make some sense. And maybe the global equity allows the manager a little bit more freedom, but we should probably view that largely as a subset of US large cap.
So I love these conversations because we inherited your prior menu, which was 4 passively managed funds. So we made a couple assumptions on what the preferences were.
Right.
And if there's a desire to move away from that, happy to accommodate for it.
Well, but you're suggesting that we do.
In part. And so the way that we thought about this, again, that if there's a philosophical difference, we can accommodate for whatever works for you all. The way that we thought about this is maintain dedicated passive exposures to the US market and the international developed markets, keep fees down, complement that with an active global strategy. So that active global strategy allows managers to be active across the globe, US, non-US. Important to note, and related to a point that Bob brought up earlier, that global equity is benchmarked to the MSCI equity, which is, call it 60-40 US, non-US. And they're not going to stray very far off that benchmark. They don't have the latitude to do that. So that fund in and of itself is going to match close to a 60-40 breakdown of US, non-US.
And that is active, right? That's actively managed.
And that's active, exactly.
This is the global fund?
That's the global fund, exactly.
Okay, that's good, because I mean, I don't mind having some of our money in passive. Frankly, it's served us very well to date, but it's hard to see that it can continue to outperform the way it has because it's all Mag 7, but
We made money the last 5 years.
Yeah.
Let's just be honest.
yeah.
And that's part of how we look at it. it's a risk to be active and it's a risk to be passive. It's been a bigger risk to be active in the past 5 years. And how long can that trend continue? Longer than it makes sense
Yeah,
sometimes.
yeah.
So maintaining a dedicated passive exposure, in our view, continues to capture what may still be this irrational runoff, but having that active management component within the global equity at least adds a little bit of active buffer, because all those managers are underweight Microsoft, NVIDIA, Apple, et cetera. They have significant underweights across the board there. So they've been underperforming passive strategies, understandably, but when the other shoe drops, if it does, it's a form of protection in that way. But again, please don't take any of this as this is what you should do, because
Yeah.
we're here to learn as well.
Yeah.
Figure out
No.
what works best.
Interesting.
Justin, anything I missed in terms of how we think about the asset allocation, the 40% target that we put forth? Not to put you on the spot, but anything that I'm just clearly missing here?
Well, a couple of consideration here. First of all, with the pension plan, it's last valuation said it was about 110% funded, which is part of the reason why we leaned more towards the 60-40 allocation, because you're in a spot where, yes, there are new ongoing benefits, but you're also wanting to make sure that you do your best to preserve that funded position. And the best way to do it is to have to reduce the overall volatility while still having sufficient return to cover future benefit accruals, interest costs, and so forth. The current assumed expected return on assets is about 6.6%. And you'll notice with all of these portfolio options, we at least maintain that. But having a few things that can help generate extra return while reducing the overall volatility, we see as beneficial. The last point that I'll make is on the global equity piece, we are believers in having an actively managed global equity piece, but only about 20-25% of the overall public equity exposure. It is a single line item, and we don't want to have too much in one given strategy, but having a well-diversified one over time, we think will be beneficial.
I can, yeah, that actually, so that said another way, since we're picking up more risk in the equity component, we're adding more fixed income to balance that.
That does help offset it, and that's why we see the impact of having a higher expected return but a lower overall volatility. Probably couldn't get that with a similar mix of 65-35.
I mean, I don't want to get too in the weeds on it, but so you've got global, I know we're not going there and I don't really want to go there, global high yield unhedged, but there's not really, I mean, we're putting all of our fixed income into US fixed income. Is there a developed market fixed income? I don't see that anywhere on the sheet, but yields had been so low in the rest of the developed world that it was a loser's game, but yields have started to pick up some.
The primary way that we access non-US fixed income is through that high yield fund. And as mentioned earlier, we're not trying to time markets, but credit spreads in particular, high yield spreads are at close to all-time lows. It's not a point where we would recommend entering
Right.
that. So
I agree. Yeah.
Holding off there, but in terms of a dedicated non-US fixed income exposure, we don't have that as a primary option within our lineups because it would just be somewhat immaterially low. If there is an appetite there to build up.
No, I just surprised it's not one of the subcomponents, but all good. My only other question, I don't want to dominate too much of this time, is where'd you come up with the 4% for real estate and infrastructure? There must be something that actuarially fell out, but it almost, if you're going into those, I'm wondering why it's not 5% or 3%, 4%.
Yeah, and one of the exercises we go through is looking generally at pension plans and putting together what we call kind of model portfolios, ideal allocations, and run a different types of analysis. It's not intended to be kind of a short-term expectation for returns. It's definitely longer term, 10+ years, strategically minded. 4% is about where we land for this allocation of overall growth type assets. You could go more into it, but in my opinion, you'd start leaning too much into a specific sector and opening up new risks potentially. With the clients that I'm aware of, the highest we've gone in a dedicated listed real asset type is about 5%. I think I'm not aware of any that are much higher than that.
Okay. Thank you.
Mm-hmm.
So would it be helpful as a follow-up for us to run a couple of different iterations of this?
Yeah, the emerging markets has really been in a drag for a long time, and there's a lot of risk to it. So if we're worried about risk, I mean, what's the rationale for adding that to the portfolio, especially 4% of it? I mean, it's bigger than the US small caps.
Yeah. The bigger risk but higher upside potential. Part of the reason emerging markets has had such a difficult run is because it's heavily dominated by China. The emerging markets index used to be over 35% of the entire index. It's because valuation of China have come down so much, it's calling around 20% of the market. And so China, their performance impacts the emerging markets performance as a whole. And so we've seen that draw down over the past 5 years, and that's why EM has had such a difficult run. The flip side to that is our valuation is to a point in China now where there's a potential upside to that. And so, yeah, not with the intended market timing, but a potentially attractive entry point for China and therefore emerging markets as a whole. But primarily, I think that was more of an offshoot. The real reason is just diversifying and making sure that we have exposure to full global market cap. And so ensuring that we're not missing any particular areas of the market that have upside potential that could perform differently at different periods of the economic cycle. We've seen periods where commodity-driven markets and commodity-driven countries perform really well, where other countries aren't benefiting from that. The emerging markets are heavily commodity-driven typically. So if we're entering a phase like that, which is unknown, but just preparing for any different type of the economic cycle, we have exposure to capitalize on that. Bit of a runaround, I know, but really just trying to make sure that we're capturing all different areas of the market and diversifying what today is only the developed market, which is what you have today in the portfolio.
Also, if you look at global GDP by market cap, the Buffett loves to do that. Emerging markets look really cheap, but obviously there's risk.
So given the 60-40 split that you estimate in global equity, what you've essentially done is taken our 23% asset and spread it out into three. You spread it out to 3 different styles: passive, the emerging markets, and then the 40% of the global equity. And you add that back up, you're back up to 22, 20, 23. Yeah. And then on the large cap, what you've done is you've taken that number and you've given some of it to fixed income, and then you've spread the rest out between the global equities and then the real estate and infrastructure.
That's right. Yeah.
I'm just surprised that tips aren't a separate category in here, but because I'm a big fan of those, but I know they're a little piece of the aggregate, but you bake in, inflation protection.
Yeah, we do have dedicated tips vehicles. It's typically not part of the long-term strategic asset allocation because we're building these portfolios for the 10 to 20 year horizon, recognizing maybe we're in a 10 to 20 year period of extended inflation. It's hard to say, but yeah, tactically certainly an opportunity to potentially add them in our what we call our models, as Justin mentioned. Our starting point don't typically include them.
Okay.
Yeah, 10 points for the,
Hopefully not. That's everything we had. So
Okay.
I'm happy to address anything that we may not have covered. Hopefully this was a helpful review for you. Right?
Yeah. No, thank you for yes. We need to probably reconvene as a RPAC group and kind of figure out what we want to do.
Well, yeah,
Like,
we-
to run
we
more
could-
scenarios.
Yeah, maybe, yeah. Unfortunately, we don't have quorum, we can't do anything.
Oh, okay.
Yeah.
Oh, okay,
This is this is an information.
okay, okay.
So we
So we
may
can
have,
really just freewheel it out.
All right, awesome.
so we may have to
Okay.
have it again, unfortunately. and,
Okay. Okay.
So we'll have to see, I mean, Bob and I are the only members that are here.
We need, so we're missing two others. We need one more, right? Is that-
We would need one more.
Okay.
And you're ex officio, but I don't think you
Yeah.
can,
No, I don't vote,
so.
no. I just get frightened by it.
No, that's fine, I mean, there's plenty of insight there, we'd like to have it, but, you know, we're kind of,
Yeah.
stymied here.
Yeah, yeah, okay.
But I think we're good, I think this was,
No, there's some good things to think about.
Yeah. I think unfortunately, we're going to have you return,
So we're there.
either by video or something when we have the next meeting, because we're gonna have to, when we get everybody together, make some kind of decision
No, this is great, happy to, that's what we're here for.
Yeah.
If there's anybody else that we could bring, so for example, I'm just thinking off the top of my head, maybe we bring in somebody with a specific focus on the global equity side. They could get some additional color commentary on how we.
here. Yeah, a little deeper dive
Yeah.
into what that is, yeah, that might be useful.
Okay, good. If anything comes to mind as you have your debrief and follow up, let me know, I'm happy to comment.
Yeah.
Great, okay. Thank you very much. Justin, Jackie, thanks very much.
Thank you very much.
Thank you.
Thank you.
Yeah, of course. Okay.
Thank you. Take
Bye.
care.
All right, thank you.
Thank you very much. It's Bob and Charles and Kiowa.
I need
Kiowa.
I'm in Florida right now. I just drove down to see my mom. I'm moving around.